Okay, let's talk about it. That dreaded brown envelope from HMRC. It lands on your doormat, your heart sinks a little, and it says you've underpaid tax. But you're thinking, no way, I've paid every single penny. So what do? Well, today we are going to turn that moment of sheer panic into a clear plan of action.
And just so you know, we've teamed up with the absolute experts at My Tax Accountant to put this guide together. These folks deal with this stuff day in, day out. So believe me, you are in very, very good hands as we walk through this.
Sound familiar? I bet it does. That's the first thing that goes through almost everyone's head. It's that jolt of disbelief, that gut feeling that the system's got it wrong. And you know what? A lot of the time it has.
So here's our game plan. We'll start with the story behind that letter. Then, we'll figure out what evidence you need to gather. We'll decode the numbers, uncover the most common mistakes, learn exactly how to fight back, and finally, how to make sure this never ever happens to you again. Let's get into it. Every tax story has a beginning, right? Well, ours starts with a sharp, experienced business owner up in Manchester. After 18 years of paying her taxes on the dot, first as an employee, then going self-employed, and finally as a company director, she really thought she had this whole tax thing figured out.
And then, boom, the letter arrived. It was a P800 tax calculation, a very official-looking notice from HMRC. And the demand? A whopping £1,200 in supposedly underpaid tax. For someone who took pride in being on top of their finances, this was a real shock to the system. So what was her first move? And what should yours be? It is so simple, but so crucial. Do not just pay it. Your first instinct might be to just throw money at the problem to make it go away. But the right move is to stop, take a breath, and get ready to investigate. Your investigation starts by gathering your allies. And by that, I mean your documents. You need to pull everything together. Your payslips, your P60, that's your end of year summary, your P45 if you've switched jobs. If you're self-employed, you'll need your invoices, your bank statements. And for business owners, your self-assessment forms like the SA 103 or your company's CT 600. This is your arsenal.
Right. With our paperwork in hand, it's time to tackle the numbers. Now, I know this can feel a bit intimidating, but honestly, it all comes down to understanding the basics of how your income tax is actually calculated in the first place. So it is absolutely essential to get your head around how your bill is put together. The tax year, as you probably know, runs from April 6th to April 5th. And for this 2025/26 tax year, it really boils down to two things: your personal allowance and the tax bands.
Now, a really key thing to notice here is that these numbers are currently frozen. So you get your first £12,570 completely tax-free. Awesome. After that, you pay 20% on your income up to about 50 grand. Then it jumps to 40% and then 45% for the highest earners. Simple enough, right? And this applies to England, Wales, and Northern Ireland.
But get this slide shows just how much your postcode can matter. If you live in Scotland, the bands are totally different. On a £40,000 salary, you could be paying almost $900 more in tax than someone doing the exact same job in England. This is vital to know, especially if you have income from different parts of the UK.
Here's a quick did you know for you. There's this little thing called fiscal drag. Sounds boring, but it's super important. Because those tax bands are frozen, any pay rise you get could quietly, sneakily push you into a higher tax bracket. So you end up paying more tax without the government ever officially announcing a tax hike. Clever, huh? Okay, so we've covered income tax, but that is not the whole story, not by a long shot. The other major chunk that comes out of your pay is national insurance. And this is where things can get even more complicated. So for the 2025/26 tax year, if you're an employee, you're paying 8% on most of your earnings. If you're self-employed, it's 6% on your profits. But look at that employer rate, 15%. That was a recent hike, and it can create unexpected costs and, you guessed it, payroll errors. Now stay with me. The next point might just surprise you. Now let's get back to our business owner in Manchester. She'd crunched the numbers for her income tax and national insurance, and they still didn't line up with what HMRC was saying. So she kept digging, combing through every receipt, every invoice, looking for that one little thing that would explain the £1,200 gap.
And then she found it. The big aha moment. It turned out HMRC hadn't made a mistake in their maths, but they were working with the wrong information entirely. They had somehow completely missed £5,000 of her legitimate, allowable business expenses. That meant they thought her profit was way higher than it actually was.
And that's not all. Here's where most people go wrong. It could be something as simple as being on the wrong tax code.
especially if you've just started a new job. Or maybe HMRC has accidentally double-counted some of your freelance income. Other common traps are things like the child benefit charge for higher earners, or just forgetting to declare the income from that little side hustle.
Here is a huge pro tip. Honestly, if you do one thing after this, do this. Go online and log into your personal tax account on the gov.uk website. Think of it as your financial fingerprint. It shows you exactly what information HMRC has on you, your jobs, your income, everything. You can compare it side by side with your own records and spot any problems almost instantly.
So, our business owner found the error. Now what? You can't just know it's wrong and ignore it. The next step is to formally challenge their decision, and there is a clear process to do this with confidence. You've got this. The process itself is pretty straightforward. First, you have to write to HMRC within 30 days of the date on that letter. In your letter, you clearly state why you disagree, and you attach all your evidence, your calculations, receipts, maybe even a screenshot from your personal tax account. If they still say no, you can ask for an internal review. And if all else fails, you can take it to an independent tribunal.
And what about our Manchester business owner? This is the best part. It was a complete success. HMRC looked at her evidence, agreed they totally missed her expenses, and they canceled the $1,200 bill. But it gets even better. Once her records were corrected, they realized she had actually overpaid in another area. They ended up sending her a refund for $800.
What an amazing result, right? It just proves why it is so important to check everything. But an even smarter strategy is to stop these letters from ever showing up in the first place. So the real key here is to stay ahead of the game and be proactive for the next tax year.
Here's your simple action plan for 2026. If you're an employee, keep your personal tax account up to date with any changes. If you're self-employed, get into this habit. Every time an invoice is paid, put 25 to 30% of it straight into a separate tax account. And if you have multiple streams of income, make sure absolutely everything is declared on your self-assessment.
So let's just end on this thought. You work incredibly hard for your money, and you pay what you owe. An HMRC letter is not a verdict. It's just the start of a conversation. And after today, if that brown envelope ever lands on your doormat, you'll be ready to open it not with fear, but with confidence, ready to ask that all-important question, is the calculation actually correct?